To understand alternative minimum tax, you need to understand how the regular tax system works. So it's pretty easy. All you do is take your income and you're going to minus your deductions, such as charity, mortgage interest, property tax, and state income taxes, and your personal exemption. So when you take your income minus deductions, it's going to equal out to be your taxable income. And we use this amount to determine how much taxes will be owed. You do this by taking your taxable income, multiplying this by whatever tax bracket you're in, and what comes out to be is the income tax that you actually have to pay. And this is the amount that the IRS makes their money on. Now what people don't realize is that behind all of this is another tax guy. He's called the AMT tax guy, and he's going to want to try to squeeze more money out of you. He does this by saying, hey, we're going to change the calculation up a little bit. We'll take your income and we'll also minus deductions, but there'll be some deductions we won't allow, such as property tax, state income taxes, and exemptions. And instead, we'll also give you one big exemption, meaning you take your income minus the deductions that we will allow, and we'll also minus one big exemption for you. This equals out to be your alternative minimum taxable income. And what the IRS then says is that we're going to tax it at one large flat AMT tax rate. And after that, you will get your tentative minimum tax. Now it's tentative because the IRS says you're going to pay the higher between the two, whether it's tentative minimum tax or your income tax. So if your income tax actually is higher than this tentative minimum tax calculation, then congratulations, you don't owe any AMT. But let's say on the income tax side you owed $40,000, while on the tentative minimum tax side we calculated that it's $45,000. So because this amount is higher, you've technically paid AMT of $5,000.